Hi, everyone. This is Jason Bierka of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. She is former managing director at Goldman Sachs and Bear Stearns, and she is the author of many books, including her latest book, All the President's Bankers, The Hidden Alliances That Drive American Power. And she's currently working on her newest book. It's supposed to be out, I guess, end of February, The Artisans of Money. Nomi Prins, thank you for joining me again.
Thank you.
Now, Nomi, I want to ask you about this strong dollar and the dollar index. At one point, it was at a 14-year high. This is despite the Federal Reserve increasing its balance sheet from $800 billion around 2008 to over $4 trillion, and that's just a stated number. You know, we don't have real audits of it, so we don't know if that's even the real number. What type of damage can a strong U.S. dollar do to the global economy, though, in your opinion?
Well, first of all, just on what you've mentioned, the fact that the U.S. dollar is as strong as it is, given how long the Federal Reserve has done their quantitative easing policies and bought securities, is very troubling in general, because it indicates that the rest of the world is far weaker on a relative basis, and not necessarily the policy that drives the dollar stronger is good policy. So that in itself is troubling. But what's occurring is outside of the U.S., for example, in emerging market countries that have had funding that has been denominated in dollars over the years, and particularly increased that funding from 2014 and into 2015 because of the expectation that rates might rise in the U.S. and money would be more expensive to come by in terms of lending opportunities, have basically leveraged themselves in debt that will have to be repaid in U.S. dollars. We saw ramifications of things like that in the 80s with major debt crises across the world, particularly in the emerging markets, particularly in Latin America. But that was based more on government debt that was owed to the U.S. and owed to U.S. private banks. But now what we have is a situation where a lot of the debt is corporate in nature, and private corporations in nature as well. So it's a different type of debt, but it is still debt that's denominated in dollars that would have to be repaid in dollars. And the more expensive the dollar is, the more difficult it becomes to repay that debt. And what we're seeing throughout the world is an increase, therefore, in global corporate defaults, which isn't a story that gets covered very much. We now have had as many corporate defaults in 2016, which were 40% increase over 2015, as we've had in any year since the worst year of the financial crisis in 2009. And that trend is upward. So if the dollar stays strong, and if oil prices, which is another component of that for a lot of emerging markets, stay around where they are, or even go up by 10 or 15 bucks, which won't necessarily change very much on the corporate level, we're going to continue to see those defaults as well. And that's going to feed into the general financial fabric of the world and of markets outside of the U.S.
So we've also, you talked about corporate profits there. With a stronger dollar, they're going to be declining probably. We're probably going to have some earnings misses coming up for large cap American multinational corporations. But you talked about dollar denominated debt for foreign corporations. I mean, on an order of magnitude from the 1980s, the debt is just up in total amounts. So we have corporate debt up orders of magnitude. We have government debts up orders of magnitude. So I think the number that some of the estimates I've seen is over $9 trillion total in foreign dollar denominated debt when you add in government debt plus corporate debt. I know the corporate dollar denominated debt from foreign corporations is at a record. It's over $3.5 trillion. But when you add in foreign government dollar denominated debt, you know, you're talking many trillions of dollars total. That is very sensitive to the fluctuations in currencies.
And you're also talking, and that's true, those numbers are significantly higher than they've ever been, and that's been a function also of the zero interest rate policies that the Fed has basically thrown throughout the world, and that the Bank of Japan, European central banks, other banks in Europe and so forth have adopted, that this idea of money having no cost for so many years increases the debt load of governments, increases the debt load in terms of corporations because it seems so cheap, but the currency fluctuations can really make a tremendous dent in that. And again, that's why there's a lot of defaults, and that's why the potential, this currency leverage can really continue to hurt, even if the dollar weakens a little bit, because once you start to hemorrhage profits and payments at the same time, interest payments at the same time, because the currency, the dollar, has been so high for so long relative to weakened economies in these countries, the problems that can escalate can also accelerate. And that's one of the situations that again, is causing a lot of economic hardship throughout the world that we're not really talking about, but that people are feeling and that governments are feeling, which is why we have such instability in many governments throughout the world, whether it's in Argentina or Venezuela or Great Britain, that are in many instances an indication of how people or businesses on the ground perceive their fragility, their economic fragility relative to what their governments are doing. And one of the things their governments have been doing is increasing their debt, their public debt load, and corporations in their countries are increasing their private debt load. And all of that has an impact when it's more difficult to make profits and it's harder to pay interest on what is predominantly or in a large way dollar-denominated debt.
Now, after the 2008 financial crisis, it seems that a lot of problems weren't solved. Would you agree with that? Because it seems that, the governments basically bailed out the banks. They didn't allow firms to go bankrupt. They didn't move all the bad debts into like a separate bad bank or anything like that, and a lot of moral hazard was created with the banking executives. So do you think then that because there wasn't firms that were allowed to fail, that we've set ourselves up for a much larger crisis in the near future?
Well, absolutely, and for two reasons. One is that the financial crisis was a banking regulation crisis as well. I mean, it was a situation where banks that were so big, quote, too big to fail, were also so deeply leveraged and so connected to retail debt or mortgage debt throughout the country, repackaging that debt and leveraging against that and reselling that and so far and sort of exacerbating that problem throughout the world, that when you don't make those banks smaller, when you don't legislatively curtail not just their size, but also their ability to have the opportunity to take consumer debt, to take mortgage debt, to take any kind of on-the-ground type of security and make that more complex and infuse that with more concoctions of derivatives and sort of non-transparent transactions throughout the world, you continue to maintain the problem. The difference now is that we've had almost 8 years of a subsidized problem. So not only were these banks not made smaller, not only were their CEOs not, put in jail or slapped with actual personal fines or their boards completely, kicked out because they missed so much of what was happening while it was happening. Not only have we had over $200 billion worth of fines, probably more if you sort of, net out all the smaller or the mid-sized banks in countries throughout the world. But in terms of the major banks that have been paid for crimes that were committed by these institutions in the run-up to the financial crisis and since, in areas from LIBOR fixing to FX rigging to mortgage-related fraud to credit-related fraud to, all sorts of other smaller types of crimes or civil crimes. When none of that has been fixed and all that has happened is there's been these fines, you do create the moral hazard. So when you add up the moral hazard with the fact that there's still the size of these institutions, both in the U.S. and take Deutsche Bank in Germany and so forth, and the fact that for 8 years they've been subsidized by the Federal Reserve in the United States with rates zero or now a teeny bit above zero, the ECB at negative, the European Central Bank at negative, the Bank of Japan, which has a slightly different relationship with its banks because they weren't at the epicenter of this particular crisis. They were in the past, so they didn't have the exposure this time, but they're still subsidizing their financial system and their government with no cost or negative cost money. When you add all of that up, we basically leverage the entire world on the basis of central bank intervention, as well as not fixing the original problem, as well as keeping the institutions at the core of the problem as big as they were, as well as not punishing them. So yes, you look at all of those factors, and we are facing a much bigger crisis when any of those change significantly or produce a problem that ripples through the rest of the system. And that could be a major rate change, that could be a major bank failure, that could be a major derivatives failure, that could be war. I mean, it could be many different things that could come into effect. But what we have set up is a much worse environment for a potential crisis than we had going into the financial crisis of 2008.
Yeah, I agree. I think we're in an economic minefield now, and it seems like the politicians and large Wall Street investment bankers and central bankers have just created more and more mines with more and more credit bubbles, and they've created imbalances and asset bubbles that were either much smaller or not apparent before 2008. Now they're just larger, and there's so many more of them. Do you think this can continue for another couple of years, where central banks will come up with, new liquidity programs to continue to expand their balance sheets with either currency swaps or the SDR being implemented? Or do you think the central bankers are running out of, in that the Federal Reserve and the ECB are running out of limits to how much they can actually expand their balance sheets?
Well, I don't think they have limits. Because we've seen that, and had there been limits or the concept of limiting themselves, this would have happened years ago. So although the Federal Reserve discontinued its own quantitative easing program and stopped its balance sheet at $4 trillion or $4.5 trillion or whatever, because again we don't necessarily know all of it, but let's just say it's the number that gets reported. They still have very cheap money. So even though it's at 50 basis points, technically that leaves them 50 basis points of room to go back down to zero in the event of a crisis. So in a way, they kind of ratcheted up the room they might have to expand monetary easing, or what I call artisanal money creation, if they need to. They've got some more room. The Bank of England has 25 basis points of room if they wanted to go down to zero, and they could go down to negative. And the UK certainly has its problems, as Brexit indicated, with respect to how voters, how citizens felt about their conditions. You have the ECB, which is at negative, but Mario Draghi extended their quantitative easing program from what was originally going to be the middle of 2016 to March 2017 to now December 2017. And what he said was he would reduce the actual purchases of securities, but extend the time during which he was purchasing them. So basically didn't change anything. If you do the math, he extended ACB quantitative easing, and he said he could extend it more if he needed to. So that's that. The Bank of Japan went up the yield curve, so having had rates at negative, which they did last January 2016, they now have a program where they're effectively keeping the 10-year rates down as well. So they've decided to do a different kind of quantitative easing. Or they did quantitative and qualitative easing, and now they're sort of moving up the yield curve. So yes, they do continue to find ways. Technically, you can have central bank buy up the whole yield curve, right? I mean, if there was an ability, they are trying to find it. What's happening is they are also coming up, though, against sort of all of the buildup of this over the years. So can it go on for another couple of years? Yes. Technically, there are ways to expand artisanal money or quantitative easing programs. I just named some ways you can do it, and you can extend along those ways. So it's absolutely possible. There is nothing in their way. Where it becomes problematic is when a lot of systems go wrong at the same time. If you have a bank failure like a Deutsche Bank in Germany, and Bank of America here, say in the United States, and you have problems in Italy, which you've had, and then you have problems in Spain, and then many of the banking institutions in South America are having issues because countries like Venezuela and Argentina, actually throughout South America, are doing poorly. If you start to have a lot of things happen at the same time, then it becomes difficult for the banks, the central banks even, to handle it. But as long as they can continue, as long as these problems are isolated, they can sort of continue this tag team global approach to making money cheap enough to maintain enough liquidity in the system to bolster asset bubbles and to keep these banks alive. So it really depends on when they stop that, or when they're unable to continue to do what they do, is when there becomes an overwhelming and simultaneous time problem between banks and between countries. And those occurrences are so tightly connected in terms of just time space that they become unable to use the types of arsenal they've been using to contain those problems. And that's very likely. Because they have been unresolved. The problems with the financial system, they've merely been subsidized by central banks. So it's easy to see how they could all happen to go into problems at the same time, and they're codependent in terms of their trade relationships, their derivatives books, and so forth. That one can have a domino effect. But until that happens, central banks have been able to sort of isolate problems that come up by moving within their regions, and to continue to sort of ultimately have a global zero interest rate, which in itself is an indication of a very fragile financial system, but which they've been able to maintain.
Yeah, it seems like a lot of these central bankers, whether it's the Federal Reserve, ECB, Japan, Bank of England, have been coordinating things with their exchange rates, with monetary policy. I call it covert QE or backdoor QE with the currency swaps. We know that the European Central Bank got $10 trillion in currency swaps from the Federal Reserve after the 2008 financial crisis to help it out, and that's not counted on their balance sheets, as expanding the balance sheet. The Fed it's not counted. It's counted differently as a normal balance sheet exposure. But that we have central bankers, though. We have the Swiss National Bank owns $60 billion worth of U.S. stocks, kind of ridiculous. We have Larry Summers, who's been writing a lot, talking about how the Federal Reserve should have their laws changed and they should start being allowed to buy up U.S. stocks in the next crisis to prevent asset prices from falling. This is just head scratching, Nomi, that they'd want to keep doing this stuff. It seems like they're the degenerate gamblers here, that every time their policy decisions don't work, they just keep saying, oh, we didn't do enough of it, we have to keep doubling down, and that's why it didn't work.
Right. I mean, that's what Japan's been doing, right? They've been buying stock, and that's what the ECB is is sort of close to doing. I mean, they're buying sort of not particularly good corporate securities. So I mean, they're definitely they are bolstering capital markets. And this is a new phenomenon. I mean, this is something that the financial crisis gave way to. So the solution, going back to your other question, to the financial crisis, of not just not doing something to contain the banking system, but the entire financial system being bolstered by fabricated money, and whether you call it quantitative easing, qualitative, zero reserve, NERP, it doesn't, whatever aspect of it that you look at, it all comes down to artisanal or fabricated, artisanal, as I call it in my upcoming book. And I just want to correct you. It's actually, I have to finish it by February. It's coming out in the fall. But the idea is that these institutions that whose leaders themselves are really appointed and not even elected have a tremendous impact on markets and therefore on economies globally. And that's something that's very new. I mean, not that they weren't powerful in their own right to begin with, but on a coordinated level, they have become much more powerful. And the Fed started it in the wake of the financial crisis, bringing rates down to zero. But the coordinated efforts, like you mentioned, in terms of currency swaps and so forth, are backdoor ways to continue to provide effectively money, whether it's dollars relative to euros or whether it's yen relative to euros or whatever the swap is about. It is about the idea of providing external funds to that central bank. The idea of it on its surface is to purchase or sell the currencies involved, but the reality is you're providing capital, you're providing cash, you're providing liquidity, and it's fabricated. It's not earned by companies. It's not even produced from tax revenues. It's simply fabricated, but it has a very artificial impact, therefore, on markets and on economies, because it isn't produced by the economy and going back to the economy. It's simply going from balance sheet to balance sheet of central banks, and it is used in a way to ensure that the governments involved have this appearance of being in control of their economies. If the market is so high, like for example in the United States with the Dow, at records and having been sort of close to records throughout these years and continuing to hit sort of new ones, that looks like a positive for an economy. But the reality is, you're talking about just a reallocation of cheap leveraged money through the system that emanates from central bank policy, because it isn't being produced by government policy, or if it is, it's not effective government policy. So that's been something that's happened throughout the world in the major countries. The less major countries, where you have rates like in Venezuela at 20%, or even in Russia, which is actually doing much better now as an economy, despite all the sort of Russian stuff, at 10%. I mean, they are higher, but the core countries are still producing money at zero on average.
Yeah, China's gotten into the currency swap game too. They've done over 35
Yeah.
currency swaps in the last few years. Now, they're not in the, trillions of dollars like the Federal Reserve is with their buddies to maintain the status quo. China's trying to, set up its for the next global financial system. So they're going to Egypt or Brazil or Venezuela,
Right.
and they're setting up credit lines, and they're trying to, I guess, arrange natural resource deals. Now, you were just in Brazil for a recent trip. It seems kind of perverse. We hear not only do we have a strong US dollar in the dollar index, we have record amounts of dollar denominated debt, like we said earlier in the interview, but we also have a dollar shortage on top of that because there's record amounts of dollar denominated debt and the people need to pay it back in dollars. So you were just
Right.
down in Brazil. How did they think about this? They kind of want to go to a new financial system, and yet here they are owing back lots of dollars as well. It seems perverse to me.
Well, it's hard, and that has an impact on where they are politically. I was in Brazil before the switching of the government from sort of left wing, more closed government, or the one actually that was working more with China, to the one that's now working more with the U.S. So there's this sort of ideological shift that happened in terms of the government. I mean, it was done on the surface. Because of scandals, but the reality is it had a tremendous impact on shifting the alliances of the government to the West, to the U.S., and that is also partially something that is related to reliance on the dollar and reliance on the Fed and reliance on just keeping that type of relationship with the U.S. Over China, which is something the U.S. wanted, and that's sort of a bigger conversation. China, where I was, and actually Japan have an interesting relationship because, as you mentioned, China has been increasing its swap lines, its currency swap lines through the bank. It has something like 40 of them now, and they are continuing to provide lines to countries with whom they are also establishing diplomatic and trade and other types of political relationship. So this isn't just about money; it becomes more about about political power and that can become about military power and so forth. So again, the catalyst of the financial crisis has created all these sort of new alliances throughout the world as well. In Japan's case, Japan doesn't have a currency swap line with China because of background historical issues between the two countries on the government level, and so the central banks haven't adopted a currency line with each other. However, they are discussing a lot of new trade agreements, and China and Japan and South Korea are discussing new trade agreements, and those would be denominated in their own currencies and take place outside the U.S. dollar. So what's happening is, though the dollar has remained strong, and the process of zero interest rates and quantitative easing, that whole policy from a monetary perspective has pervaded the globe. The other result of that is that China and other countries have thought about the risk as well as their position in the world that is associated with the dollar and the policies in the financial system here and so forth that are connected to the dollar, and have adopted ways to and continue to adopt ways to get around that. So you've also had when we will have that shifting in the world, the SDR basket that with the IMF that now has the Chinese yuan in it, that was a push from the People's Bank of China and China to have their currency be considered a reserve currency, if only and as a starting point with respect to the IMF's basket. But that is something that, it's a starting point. And it is also not just an element that relates to currency, but an element that relates to future political power as well. So there's a lot of flux that's occurring on a geopolitical basis that started with the financial crisis and how banks and central banks in particular responded to that crisis.
Yeah, I think the elites, the people running things, kind of want to go to the SDR, but, it takes a lot of time to set that up. So I think that's why the currency swap lines are increasing, because they need that extra liquidity, but they can't go in public and they can't go on TV and say, we're going to do large liquidity programs to bail out the banks because that's politically unpopular. People know, bank bailout, QE, they're familiar with those words. That'll start to bring out the pitchforks. So the money still needs to be created in one form or another, but they can't, go and publicly announce that unless we hit a crisis level and the pain point with the asset prices and things get so bad to 2008 levels where maybe some people would be more favorable to that in polling. But we're not at those levels in the polling where most people would be in favor of those types of bailouts and liquidity programs. So it seems to me like the the central banks and the bankers. I don't know if you saw this last month, but the Federal Reserve put out a weird press release, and they basically said they ran the numbers and that U.S. and European banks only needed $70 billion worth of capital injections, but that the Federal Reserve and the ECB didn't want to do bank bailouts anymore, that they would force the banks to sell more bank shares of equity and more long-term bank debt. But then I was thinking to myself, who would buy the bank shares and who would buy the long-term bank debt? So it seems to me that there's going to be some type of weird bail-in scheme where maybe they go after people's retirement accounts in, Germany for Deutsche Bank or the US for maybe national security purposes. They're going to say, oh, for national security, Nomi, you and me each have to put 1 or 2% of all of our retirement accounts into either government bonds or bank stock equity or long-term bank bonds. Do you think that's realistic based on some of the things that they've put out in press releases?
Well, first, I just want to say that what they put out in press releases and what they say and what they do are not necessarily the same thing. We should realize that just from the standpoint of they were talking about potentially going non-accommodative for 8 years, and we're only up 50 basis points from the Fed perspective, and we're down negative in Japan and throughout Europe. So a lot of what gets said has a lot of room for maneuver in it. I think that first of all, $70 billion could be non-leveraged capital. I mean, that's a very, very low number, but we're not looking at a non-leveraged banking system. So whatever that number is remarkably low considering what we know can happen in any financial crisis in a leveraged environment. So that in itself is kind of BS.
But that $70 billion, sorry to interrupt you, Nomi, but that $70 billion sounds like Deutsche Bank would need almost all of it by itself.
Right, and Deutsche Bank just, exactly. I mean, that's just that's kind of ridiculous. That's basically going into the stress test that central banks have had on banks and saying that, if everything's fine except for like one factor going wrong, then they'll have enough capital to handle it. Well, that's true. But a crisis isn't one little thing going wrong and having enough capital to protect themselves. And that said, last April, when our banks, 7 of our 8 banks basically failed their stress tests anyway. Some failed them with both the Fed and the FDIC, and Morgan Stanley and Goldman Sachs swapped off. One failed with one and one failed with the other. So 7 of our 8 largest banks aren't even doing well enough. So to come up with a $70 billion capital figure, just whatever, it doesn't even make sense. But what any of these central banks can do, and the ECB and Bank of Japan have done this in different ways, is that they can buy bank debt, and they can decide to buy bank stock, and they can decide to inject in a sort of TARP manner into that stock or into preferred shares or whatever it is they would be calling it at the time. They're not going. The thing is this: the Federal Reserve will not let J.P. Morgan Chase fail. That's just simply not going to happen. So if there were a situation where it was at some sort of a brink, the Fed's going to figure out how that's going to be contained. So whatever they say now is irrelevant to what could occur in an actual crisis. So that's one thing. But that said, the place that's also available are people's deposit accounts, are our bail-ins, are is the ability to reduce people's ability to take or extract their own cash out of their own bank accounts. That's something that's very easily done, and for which there is language in some of these emergency plans, because the banks themselves had to produce plans. Again, many of which failed in terms of ultimate testing, or that had inadequacies attached to them. But banks know that one of the places they can get capital is from their customers, is from their depositors. And so one way to do that is to, again, reduce people's ability to get access to their own money or get access to enough of their own money if there's a problem. One is to increase, sort of, say, withdrawal fees. I mean, there's different ways to make money out of the fact that these institutions are still, post-Glass-Steagall repeal institutions, meaning they have access to people's deposits and they have access to creating securities and leveraging them in the markets and selling them, related to the fact that they have these deposits and they have people's they hold sort of people's personal accounts in the same institutions. So that's more likely. In terms of retirement accounts, that's another place. I mean, a lot of these institutions also manage retirement accounts or portions of retirement accounts. So again, you can slap on extra times to selling, so that people, not necessarily that people pay a fee in order to have like an emergency fee, but it works the opposite, that people actually find that they can't access money from their own retirement accounts because it is locked up during an emergency situation. So I think that's the more likely scenario, is that in an emergency, banks hold on to the liquidity that they have, the capital that they have. And what we've seen since the financial crisis, the attachment to the central banks that will help them produce liquidity and help them produce cheap capital. So anything that looks like that easily will happen in a crisis.
Yeah, it seems like there's going to be some combination of either covert bailouts and then also, some type of bail-in, whether they go after the deposit accounts, checking or savings accounts, or after people's retirement accounts for different reasons. There's going to be some type of combination of it. For me, I'm a libertarian. That's totalitarian government. I don't condone any of the bank's behavior. I think they should have been bankrupted. I think, there was already lots of laws on the books that the banking executives committed fraud in 2008. They should have been put in prison, and those laws weren't enforced. And I shouldn't be penalized as a taxpayer and putting my money in a bank account for the bad behavior of the banking executives. But, and yet it seems for the greater good that people in power have decided, we can't jail the bankers. We have to keep the banks intact, can't break them up. And they're keeping the system going. It's a zombie system. And the banks just keep getting larger with larger and larger liabilities.
Yeah, I mean, I can't summarize it better than that. The reality is we, i.e. the governments and central banks in combination in the major countries, decided to subsidize their financial systems at the expense of their populations, and how that manifested in terms of people who should have been in jail not going to jail, fines being levied instead of businesses being demolished, banks becoming larger instead of becoming smaller. I mean, all of that was really sort of rewarding very bad behavior, but with an expense to us. And an ongoing expense. And the only reason it doesn't appear to be hurting us like every day is because there hasn't been an actual acute additional crisis. But just the fact that these cheap money policies and slap a couple of fines and move on types of policies have existed for so long is an indication that the financial system it does have the ability to go into a crisis mode, and quite easily. Otherwise, all of these policies and all of these excuses would not have been as prevalent for as long since the financial crisis. And that's a problem. And yeah, whether you're libertarian, conservative, liberal, it doesn't matter. When a market crashes, when your retirement fund gets pillaged by lower values because the values to begin with were puffed up by artificial means and not by something more organic, that just affects everybody in their pocket, no matter what their ideology is. And then that's part of the problem, is that's a global problem. It's not just in the U.S. where we really started. Our banks really started the financial crisis, and our Federal Reserve started this false remedy of dealing with it, as opposed to the government actually doing something more meaningful or at all to change it. Is something that's now a global policy, and that's why I think there's just so much economic unrest in the world, that the people know this, and whether they transfer, they actively think it's because of a bank and because of a government, because of the central bank, doesn't really matter. They still feel that inherent fragility in the system in their sort of world.
Yeah, and a lot of this money, Nomi, that was printed, the many trillions of dollars, Jim Rickard says it was over $30 trillion in liquidity programs since 2008. None of it really went into the real economy to create jobs, new goods and services. So, it's in the real economy in the United States, I think it's experiencing stagflation now. And I think with potentially Donald Trump taking over here, it could get even worse stagflation if his supply side economic policies for infrastructure, defense, potentially building a wall, these things I could see inflation in a couple different ways. I wanted to transition now to Trump. Trump is talking about protectionism and tariffs. Now, Smoot-Hawley didn't didn't cause the Great Depression in 1929. There was other factors with credit bubble and the Federal Reserve. We discussed this on past interviews. But how dangerous is it if Trump starts putting in very big tariffs on the U.S. economy? I don't think it's going to bring back nearly as many jobs, especially now that we have 20 states that are implementing higher minimum wage. It looks to me like when you add in those potential tariffs plus automation, that we're going to have some jobs brought back, but that it's going to it's going to be kind of a lot of debt increasing, and it's not going to be as good a recovery as Trump has been promising.
I think that's right, and there's a bigger reason too, and I think what Trump started to do, and I'm sure he'll continue to do this when he takes the Oval, is really take credit for some of sort of these movements, like Ford not deciding to sort of rebuild a plant in Mexico it otherwise would have built, and sort of bringing back, quote, these jobs to the United States, when in fact that was a business decision that didn't have anything to do with Trump, as Mark Fields, CEO of Ford, even said. But what Trump, I think, is doing is trying to rack up these sort of wins of 1,000 jobs here, 1,000 jobs there, to indicate that the policy of ensuring that companies bring back jobs to the United States is something that he's A, given credit for, and B, can, if the economy does get better for more people, he can take credit for. And the reality is, first of all, these things were happening anyway, but also the bigger thing about tariffs is when you hurt, and this is the fine line with any trade or just or capital agreement with another country, is that if you hurt the other country, and you're dealing in sort of cross-border currency transactions, you have the ability to hurt people here. If you don't have as many people in another country buying your products, or it's more expensive for them to buy pieces of those products, and then they're sold back more expensively. Even if we have more businesses hiring people in the United States, net, we could still be hurting ourselves by forcing other countries to pay more to have things imported into the United States, or to reduce the strength of their currencies, or both. And so that could be a problem. So the net initial effect could be that it looks positive, and that could give perhaps a boost to some companies, or a boost to business confidence or consumer confidence. But the reality is, over time, if you're not creating enough jobs to produce enough money here for people to both create and buy here, and also to maintain sort of good values with what you're buying and selling to neighboring or other trade partnership countries, then you start to have problems. And then you also have this thing we were talking about before. If the U.S. has tariffs that are too high, let's say, then because we're such a globalized world, other countries have the ability to just exclude the U.S. from certain transactions, which could actually make things that we import more expensive just by their scarcity value, if those countries are also trading away. So there's a lot of nuances in what could be behind, or what could be the ramifications of these policies, and it's not necessarily good.
Yeah, I agree. I think there can be a lot of unintended consequences with these tariffs. Now, they may bring some jobs back, but they could, if you look back through history, they could create a trade war. And, they could create a situation where a lot of high-tech companies in the United States, they need rare earth metals from China. And so China has a monopoly basically on processed rare earth metals that go into all the high-end electronics we need in computers, smartphones, et cetera, tablet PCs, et cetera. And China decides, if you're going to put a 40% tariff on our imported goods from China, we're going to restrict your access to rare earth metals. So,
right.
So I mean,
right. And then you have a trade war, and then you have a currency war on top of that. And again, the triple threat on where we are now in our financial and economic cycle is you also have had a monetary policy war go on for 8 years. So you really have sort of triple set of economic wars happening, which aren't necessarily the best way to move either our economy forward, their economies forward, or our mutual economies forward.
Yeah, so it seems to me that this nationalism that's coming up, it may bring back some jobs. And obviously, I didn't like the way things were going with this one world government central planning type of deal. But it's not going to be as easygoing as some of the people expect, because I don't think the tariffs would fix the economy as much as people think. I think there's a lot of rules and regulations that are against small businesses here in the United States that make it very difficult for a small business owner in the U.S. to compete with a large corporation in the U.S. I mean, it's ridiculous how when the politicians try to tax the corporations, how the corporations can easily move around the laws and not pay taxes, and then the guys who end up getting screwed with the higher taxes and the regulations and all the extra fees are the small and medium-sized business owners in the U.S.
Actually, that's very true. And one thing will be interesting, among others, to see if Trump can accomplish, because he hasn't really spoken about it since earlier on in the campaign, is to potentially loosen some of the restrictions or just some of the costs that are levied on small businesses relative to medium and larger businesses, so that they actually can have a more competitive playing field, to sort of help alleviate the problem you were just talking about. And it was something he sort of mentioned, but it isn't something that's really been prevalent in sort of the end of the campaign or recently. So we'll have to see on that.
Yeah, and I have your 2017 predictions article here. So you think then that a lot of the things that happened in 2016, we're going to see a continuation of them then in 2017?
Well, I mean, there's a couple of things that have changed or that will be accelerated. For example, the unrest politically in the EU. There's a lot of votes that are taking place this year that are going to show us how people really feel about issues impacting the specific countries within the EU, whether they want to be in the EU, even though they're not referendums. They are going to be votes for politicians that either support or don't support the EU as it stands. And what's been happening since Brexit, and also a number of Eastern European countries have been voting in, as their elections have come up, people that are more anti-EU, more pro-national, and or sort of exiting from the EU, or in Eastern European countries' cases, more pro-Russia. So there's going to be a lot of shifting, continued shifting in Europe. I mean, they'll have a weakening effect on the euro and so forth from a currency perspective, but there's going to be a lot of political unrest in Europe. There's also going to be a lot more problems with contagion in South America. I talked about problems last year in South America, but with ongoing issues in Argentina, ratcheting up issues in Venezuela, Brazil having had this now shift into a new government, but the question is, they're about to slap a 20-year austerity program on the country. That's not going to go over very well. So that's going to create unrest there. So some of what was happening in 2016, I just think gets a little bit worse in 2017 from the standpoint of rates and the dollar and everything else. I think that the dollar, I've said this for years, shouldn't be as strong as it is given our policy, but because other countries are so much weaker and there's that reserve reliance, it sort of has that bid. But I do think that part of its strength is the anticipation that the Fed might be on a new rate hike spree. I don't believe it is any more than I thought it was last year when it raised rates by a little bit, by 25 basis points in 2015. It didn't raise rates until the end of 2016 last year. I don't see it raising rates by more than 25 basis points this year. So I think that will ultimately temper the dollar again. So it'll have this sort of increase in the beginning, middle of the year like it did last year, and kind of die down a little bit towards the end, and it won't have the Trump effect to pump it back up at the end of the year, and that might open some way for, say, the yen to appreciate as a sort of currency, safe haven type currency. And also it'll be interesting to see what happens with China's relationships outside of the United States. There's this perception that China's economy is not as strong as it's been, and obviously there's a lot of debt floating around, but also its government has the ability to produce more and to support its own systems, and I think it'll continue to do that, and it's been very aggressive at finding political and trade relationships and establishing alliances outside of the U.S., and so I think that's going to be a big story for 2017 continuing.
Yeah, I think if the dollar index continues to strengthen too much, that could collapse the global economy with all the dollar denominated debt that's out there. If interest rates rise too quickly in the United States, that could potentially collapse asset markets and the global economy. So I think they're trying to, not do too many of them. I mean, the Federal Reserve in 2016, what they promised 4 interest rate increases, and they did one, and
Right.
there's lots of people on Wall Street that still give them credibility. I don't give them any credibility. I think that's
No, I don't. Yeah, I agree. And just sort of interject, but they promised 4 last year and we got 1. They promised, in the 2015 we got 1. In 2016 they promised 3 at the end of 2016. So if you do the math, they actually promised a more accommodative monetary policy for 2017 than they did for 2016, where we only got 25 basis points. And the other thing is, even though Trump coming in and during the election has talked about the Fed being a political body, which of course it is, but sort of disparaging that for that, he also and his people will have to know that doing too much too fast does have that potential to collapse not just the global economy but our markets, as happened last January. And it's not happening this January after the hike because of the whole Trump effect and the sort of promise that or he's being given to sort of spur growth. But if that doesn't happen or things slow down and Congress is Congress, that or is going to go away pretty fast. And so what you have left is the Fed keeping rates low to keep asset prices high, to make everything look good. And I think that will be happening.
I think supply side economics, which is Trump has been talked about. Trump's a big fan of Ronald Reagan. It's a dangerous game considering we already have almost $20 trillion in debt already, the
Right.
official debt. So, a lot can go wrong with doing supply side economics when that debt level is already so high.
And I don't think Congress approves it anyway. So,
Well,
that's besides the point.
Yeah, I mean, there's so many executive orders now with the president that the president has power to do executive orders. The Federal Reserve is above Congress
True.
Anyway, Nomi. So, I mean, the Federal Reserve, like, if the Federal Reserve actually got a full audit, I mean, if Congress actually got a full audit instead of a, one-time partial audit of the Federal Reserve, I wonder what we'd really find out.
Yeah, no, it would be interesting. But again, I think the Fed is going to be Trump's friend in a way that will not particularly be public, but will exist.
That's very interesting. Well, yeah, because I think Donald Trump does need low interest rates. He did the populist argument
Exactly.
saying that rates are artificially manipulated lower, the stock market's a bubble. Him telling the truth like that helped him get elected. It resonated with the people. But here he comes, with his infrastructure and spending plans, and I don't see how the math works, the numbers work without him needing lower interest rates and money printing programs.
Precisely. So which is why he has been very quiet about Janet Yellen and the Fed very recently, because he does, at some level, he must know that.
Well, I have one more question before I let you go. It has to do with Bernie Sanders. I know since you were on his economic team, how angry are you how Bernie Sanders was screwed over by the DNC now that we've seen the evidence come out by WikiLeaks about the DNC leaks?
Yeah, I'm sad about how I'm angry, and I'm sad about how that all went down. I mean, the fact that the DNC, that the Clinton campaign, basically didn't allow him to be, or the Clinton campaign went to, but the DNC didn't really allow him to become the candidate he was becoming, which is that here's a guy, and he still needs to be given credit for this, like all the time, who basically was able to raise money for more individuals and more smaller contributions, but massed into a larger sum and without corporate giving to him, than any other candidate that's run for office. I mean, he did something very huge, and he tapped into people who were on the progressive side, but also on the conservative working side, and also even on the libertarian side of it, even though, that might not have been his strongest space. It was clearly progressive, but the reality is he touched a lot of people's sensibilities. And so I think the fact that the DNC didn't understand his momentum and his message was a big reason for why they failed, and why their candidate failed. So yes, I think that was all very unfair. And I think right now what's interesting is some of the issues that Bernie is continuing to champion, which were issues from the campaign and issues that he's had throughout his entire political career, are ones that are very necessary to the United States on so many different levels. I mean, he's talking about, for example, him and Trump were agreeing just now on pharma prices, on sort of capping and allowing a better bidding process for drug prices, which, one of many issues that could help people regardless of their political ideologies. And so he continues to be a force that Hillary Clinton just simply isn't, which just confirmed people's opinions of her, who had much higher opinions of Bernie Sanders. And so, yes, that I think that it'll be an ongoing, as we look back at history, there'll be sort of an ongoing, I think, analysis of what could have happened had he been given sort of a fair shot by his own party, because he certainly had support of an accelerating support of voters, and particularly working class voters.
I didn't like a lot of Bernie Sanders' policies, but, looking through the evidence from WikiLeaks and the other stuff that's come out, I mean, he was totally screwed over. He should have won the nomination. It looks like entire states in the primary were stolen from him. Clinton getting the debate questions. I mean, the deck was stacked against him. That's just not fair. I mean, the same thing happened to Ron Paul in the Republican primaries over the years.
Yeah.
Yeah, so it's just very. I think he probably should have won the nomination, but the large corporations and the banks who control the Democratic Party and the Republican Party were not in favor of Bernie Sanders. So.
No, they certainly were not, and I agree. Had it had been a fairer process, I mean, even not having Sunday night debates, I mean, all that to add into the elements of the unfairness of the process, I do think he would have gotten the nomination. But yeah, it is true that the financial forces, corporate forces would not and would still not choose him as their candidate.
Yeah, I agree. Same thing with Ron Paul. Too extreme, doesn't fit. The controllable corruption there from the military-industrial complex and the banks that most of the Republicans and Democrats have bought into.
Exactly.
Well, Nomi, I really enjoy our discussions. We're around 50 minutes. I appreciate your time. If our listeners want to buy your book or look at your articles, I'm going to put a link to your 2017 predictions in the info section of this interview. How do they find the rest of your work, though?
I think, basically my website's the best place because it'll have links to my books and my articles. And if I'm talking anywhere or anything upcoming, it will have information on that as well.
Excellent. Well, thank you for your time, Nomi, and I look forward to reading your book. I read All the President's Bankers. I found it very interesting to learn about the hidden relationships. FDR was pretending about being for the people, and here he was, you disclosing that he was having, secret meetings with Wall Street bankers away from the media and stuff like that. Sounds nefarious, like how the Federal Reserve was created in the first place.
Mm-hmm. Yes. There's certainly some good stories there, and all of them were based on actual documented information. So that was a good book to write. And when I'm writing Artisans of Money, which again I'm finishing hopefully in February, and it'll be out in the fall, I'm also screening a lot of the documentation between central banks in terms of what they were actually saying behind the scenes and what was actually being said to the public. So that should be interesting when it all comes together as well.
Very good. I look very much forward to that.
Thank you.